Hi, Talis. Great having you as a guest in our podcast, and thanks for accepting our invitation. It's a privilege talking to you.
Thank you. The pleasure's all mine. Thanks for the invitation, Swami.
Uh, Talis, I would like to straight away dive into the conversation. And the first thing I want to talk to you about is really where did you discover this uh, concept of disruption being very different from what has been seen before to what is being seen today? So, where did you discover this? And can you tell us the story behind how did you come about this, difference that you saw?
Great. So I think the first time I saw it, it was in maybe around 2010. And I was invited to Facebook headquarters to give a talk about my early research as a professor at the Harvard Business School. And my research was on economics of attention. I had written some articles on viral advertising for Harvard Business Review. And so Facebook, before its IPO, it was a fast growing company, but not the giant that it is today, invited me to give a talk. And I got to see Mark Zuckerberg programming on his computer in flip flops. And I gave my talk, and afterwards they were nice enough to give me a tour of the place, and we had a chit chat. And I tried basically to understand at the time what was Facebook's plan for really growing really fast. And they explained it to me, and I just wrote down a few pointers, and I just put it away. Went back to Boston to my work, and about a year later, I was invited to give another talk, and this followed, right? As my research would come out on economics of attention, I was invited to give a talk at Netflix. I went, and I had a good friend who was the CMO of Airbnb at the time. And I visited many other smaller startups. And every time I visited them, I asked them kind of a set of similar questions. How are you planning to disrupt your market? What are you going to do different? How are you going to go faster than the others? And they would start to explain to me very specific things about their industries. But as I started asking more and more this question to the same sets of businesses, I started seeing a common pattern. And the pattern had less to do with their technologies. And so my colleagues like Clay Christensen and others, and reading about disruption in the trade press with executives, consultants that talked about all the role of technology and disruptive technologies. But these startups were talking much more about the customer, changing behaviors, and how they were planning to kind of offer something different and unique to customers. And so that was the first glimmer that I started seeing that the reality that I saw with these startups was not compatible with this idea of technology as being the biggest driver of disruption.
Interesting. So what was your take? Was your take that technology was not the primary driver of disruption, but the business model is the primary driver? And where did you come to that thesis and conclusion?
So I think the first realization that I had was when I read an article, and it was a very small startup. It was a startup that was actually one person, and this person was about, I think, 17 years old. And what he was doing is he had a website that was growing fast by selling watches online, watch e-commerce. This was about 2011, I think. And he was selling watches online, and he was doing a lot of sales, great success, and he was 17 years old. And I contacted him, and I tried to understand what he was doing. And basically what I realized is he was selling watches, but he didn't manufacture the watches. The watches was manufactured in China, as most watches. He imported the watches, but he wasn't the importer. There was another company importing and distributing the watches. And he didn't make the website. He had like another company make the website. And you would go to his website and select the watches. And he didn't even fulfill when somebody bought the watches. It was another company that did that. So basically, this kid had a business, a thriving business selling watches, but he didn't make the watch, he didn't distribute, he didn't deliver the watches, he didn't make the website, he didn't almost anything. I said, well, what do you do actually? Because he had his own brand and it was successful. And basically, he had a collection of companies that was working all across the what I call the customer value chain, which is the activities that you and me have to go through in order to compare, shop, purchase, and acquire watches. And all he did was, use Facebook to get attention to his website. But after that, there was all sorts of companies that did everything on his behalf. And it dawned on me how you could have a thriving business with your own brand and customers don't even know it, and that you're actually not doing any of these aspects. You just put together different businesses and they do different parts of the customer value chain. And he was growing really fast. And I thought, well, that's fascinating because in the past this was not possible, And that's where I came up with this idea of decoupling, in which you look at the activities that customers have to engage through in the process of buying and using and disposing of goods and services. And you focus on only one activity. And in this case, this kid was focusing on getting attention to his and traffic to his website. And then you disregard all the other activities and let somebody else do it. You let a competitor do it. You let a company that is specialized in doing it, but you just do one small activity. And with that, he built a business model around just doing that and doing it very well because he understood that the most important thing in watch was people wanted something distinct and something that validated that that was a good purchase. And he did that with social media advertising. The rest really wasn't a big problem. There were companies willing to do that. So that was the first idea of this, that you go into, as an entrepreneur, you go into see an opportunity. Instead of doing everything, you focus on one small activity, and then you start building a business model around this. And yes, there's technologies behind it, but it's not this idea of this disruptive technology that you have and nobody else has. It's very unique and all of these things. Most of the time, entrepreneurs, including Facebook for long periods of time, you just have the standard technologies available to everybody else.
So, Thalis, let me ask you a follow up question on this. Uh, Most often, when we see these models come up in popular books and stuff like that, we see it's almost like a stand up comedian doing a routine on a Netflix special. You see the polished version, you see the flawless implementation of the model, you see it interlinked quite beautifully with a lot of examples and other related evidence, right? But I'm very interested to know that when you were coming up with this model, can you talk to me about the first iterations of the model and how you came up with the genesis of the idea, and what was some contrasting evidence that he had that refined the model to the way that it actually is today?
So, to explain that, the model that it is today is basically this idea that in order to disrupt the market, if you as an entrepreneur are looking at all of the important activities that big established companies do. So if you want to disrupt a bank does thousands and thousands of activities. It provides checking accounts, credit cards. It provides mortgages. It provides insurance, gives you loans. And all of these activities have a huge amount of resources, people, processes, and require money to build. And so if you're thinking about coming up with your own bank today as an entrepreneur, it's almost impossible if you look at it this way. There's no way you're going to do it. You would have to have billions and billions of dollars, and you would have to have thousands of people to do it. Yet there was a digital bank in Brazil called Nubank, and then many others around the world that started their own bank. And the way they started their own bank is by, instead of looking at all these activities, they said, well, let's look at one small activity that consumers are having a hard time. And in many countries like Brazil and India, people they don't have access to a credit card. It's very hard because you need to have this history. You need to have, funds and ability to pay. And so that precludes many people from getting a credit card. It's a long process. And this company said, you know what? We're just going to give you a credit card and we're going to give you a little bit amount of money. And if you pay off your debts every month, we're going to give you more money to it. No questions asked. Bam, here's a credit card. Go shop online very, very quickly. Everything else they didn't do, right? And so the idea of decoupling comes in, instead of looking at all the activities that your customers, that the customers of the market that you're trying to enter are doing, you focus on one that is not well done currently by the established players. And you steal that activity for you to, as a business, to execute on. In the case of Nubank, just offering a credit card, right? And everything else, you just forget about it. And so decoupling means that you decouple the customer value chain, the activities that customers do, and you steal one and you start executing on it. And then when you do it well, you start growing and doing more activities across the customer value chain. And this process of decoupling is an entry strategy. How do you steal an activity to do for yourself? And so to your question, Vinesh, how did I evolve it? Over time, I started seeing startups grow fast. And I asked myself, well, they enter a market through decoupling, but then how do they grow? Well, they start looking at adjacent activities. And adjacent activities in the customer value chain might say, well, now I have a credit card and sometimes I can't pay it off, so I need a loan. And so Nubank said, well, that's another activity, and let's start doing that as well. And then they said, well, now I have a salary, I need to sometimes put my money in, and so I need maybe a digital account, a digital checking account. And then Nubank started offering that. And then customers said, well, now I have an account, I want to pay people online without my credit card, do transfer transactions. And say, well, let's give you a payments system. And this process is what I started calling coupling, because you couple activities. You add one activity to the other, to the other, to the other. And suddenly now Nubank is getting closer and closer to what a traditional bank is, but for the digital age, right? So that was another layer of innovation in my theory. But the biggest layer, I would say, that eventually I started seeing, and this is when I was teaching these concepts to Harvard Business School MBA students in my elective course, and now I teach at the University of California a similar version of the course, is understanding that if you look at activities of consumers, either banking consumers or consumers wanting to buy watches online or any product or service that consumers have to buy, if you map out these activities in the customer's process, what I learned through my students and through examples is that these activities can be classified into one and only one of three types. Is it a value creating activity, an activity that the customer derives benefit from? So being able to pay online is a value creating activity. Being able to use a watch is a value creating activity. The other activity could be is a value eroding activity. It's an activity that doesn't derive benefit for the customer, but that they are forced to do in order to achieve the benefit that they want. So applying for a credit card. If you just apply for credit cards, that doesn't give me a benefit or you a benefit. It's just a necessary thing you need to do. Book a hotel such that you can use when you arrive at the trip. Booking the hotel, filling out the form is a value eroding activity. Sometimes comparing products, like comparing insurance products, is a value eroding activity. And so we do many value eroding activities. And then the third activity is a value capturing, or what I call value charging activity, is the activity that you pay the business for. When you buy a watch, or when you pay your credit card bills, or so on and so forth. So any product or service across the customer value chain will have value creating activities, value capturing, value eroding activities. And when I understood this, I realized that no matter what industry you're in, no matter what product or service you're selling, there are three types of disruption that you can do. You can either decouple a value creating activity, or a value eroding activity, or a value capturing activity. And this kind of, when I learned this, it suddenly started being able to apply the theory in a variety of industries, sectors, and countries.
So let me ask you another question where I think it's very interesting that he took the example of Nubank, because Nubank brought forth this innovation in Brazil, which is a developing country, right? So a key difference between a developed and a developing economies is developing country is how their institutions and how their markets are organized and how these various actors engage with each other. And so, based on how you have seen firms provide services to customers, my question is, what do you think are the differences between developed markets and developing markets when they're trying to create products and services across the value chain for customers?
That's a great question. I think one of the big things that comes to mind is the issue of access. In the United States, where I live, and I live in the state of California, one of the richest states of the United States, uh, access is not a big problem for products or services, right? Whether you're in the upper class or middle or lower classes, you have access to many products or services. It depends on how much you're willing to pay for it. But in countries like India and Brazil, many people are called unbanked. They don't have access to a checking account, and when they don't have access to a checking account, they don't have access to financial services. So they're not protected when there's inflation. When there's inflation, they have cash, and their cash start. They have cash at home in hand, and it really hurts them, and we're having a lot of inflation right now. It's hurting the people that don't have protection against inflation, right? And so the unbanked is a big portion of Brazil. And in these countries, having access to credit is super important. And a credit card that allows me to pay for something, to buy something and pay it within 30 days, or if I don't have the money to pay it a few months later, that is kind of an important financial instrument that I have. The same thing when I get my salary, I can just put it in a savings account or invest it. But in Brazil, people don't have this. And the people who do, the interest rates are sky high, really, really high for many credit cards. And so what Nubank decided to do is say, we don't want to earn that much money through kind of gouging our customers with credit card fees. We just want to provide access to customers. And so same thing in India. When Flipkart came about in India, and I brought the founder of one of the founders of Flipkart in India, Binny Bansal, to my class, and he basically said that e-commerce was growing, but and it's extremely valuable for us to buy things from the convenience of our homes. But at the time in India, about 10 years ago, if you didn't have access to payments, it was very hard to buy online if you didn't have a credit card. And it was hard to sell online because most mom and pop shops that have products to sell, they couldn't have access to a website that they could kind of take payments and offer ship products and so on and so forth. So his idea was to provide access to buyers and sellers to be able to transact online. And so I'd say, among all things, access is the important differentiating factor in developing countries.
So, Talis, when you look at your concept of customer value chain, how is it different from the theory of customer journey? Is there any overlap, or is there a difference between customer journey and customer value chain, and where are the differences, and how critical are these differences?
Great. Okay. So yeah, I get that question a lot, right? What the customer journey or the customer map, the customer process. Basically, the customer journey has been around for a long time, and it is a series of activities, generally linear, but sometimes not, in which customers go through a process. And the customer journey is generally used to help marketers figure out how to sell products to customers. And so it ends when a customer like you and me buy a product, when we buy a watch, when we buy a car, when we sign up for a subscription service or for a banking service. So that's one point. And the customer value chain goes beyond it. It's not just about selling products to people. It's about understanding how they compare products, how they acquire products, how they use the products. How do you and I use a product like a checking account? Or how do we use an insurance product, right? We sometimes compare options, we subscribe, we cancel, we use it, we do claims. All of this is part of the customer value chain. And even for some products like a car, a house, or even a television, we could even go forward and think of, after you use the product, how do you dispose of products? And more people are reselling them online. Sneakers, there's a huge market for resale of used sneakers. And handbags, right? Luxury handbags. A student of mine created a company that resells luxury secondhand handbags. And he's working in the part of kind of disposing of products. So the customer value chain goes beyond just the process of selling. That's number one. And number two, it is a strategic tool for business model innovation, not just for marketing or digital marketing. It's used to understand how customers derive value, how customers are forced to do activities that erode value, and how companies and customers transact and exchange money by that principle that I said. There's value creating activities, value capturing activities, and value eroding activities. And so it's a much higher level tool to really kind of focus not just on customer acquisition, but understanding a business model in a whole.
So clearly, when you really look at customer value chain, there are probably what you call as granular customer activities that can create innovation in business models, right? That's really, I think, something that you talk about. And I think one great example that that you talk about is a concept of a sharing economy where Uber or a Lyft is actually a customer activity that they innovated, but a whole host of companies stole away a different business process or a different customer need and built a different business model. Can you walk us through how it works, and therefore how in the customer value chain stealing that part of that business made a huge new business model?
Sure. So obviously, if we think about the customer value chain of transportation, right? Historically, why do we buy cars? Well, the whole benefit of buying cars is to drive ourselves from point A to point B. In the process of buying cars, if you map out the customer value chain, first you have the need, then you compare options, you go online, you go to the dealers. 10 years ago, people would go on an order of 3 to 4 dealers. Now they go to generally 1 or 2 dealers. They compare the options. They, see how they want to pay for it, the accessories. They acquire the car. Sometimes it takes a while for it to get to their house. They need to go back there, get the car, start using the car, and then you have maintenance. Change the oils, change the tires, all this. So it's a very long and tedious process, and many of these activities are value eroding activities. Do you enjoy spending time changing the tires, putting gasoline? Do you enjoy going and changing the oil of your car? Do you enjoy the process of applying for finance? No. This is necessary evils that we have to do, value eroding activities, right? And so when Uber came about, the idea was just to eliminate a bunch of value eroding activities. Do you need to go from your house to the restaurant, get an app, and then call a car, and then they'll take you there, right? And so Uber started kind of decoupling the process, making it much simpler for you to get a ride, and it grew fast. And it only recently became profitable or kind of cash flow positive, but that's another story. That's losing money, and many ride-sharing companies, in an attempt to dominate markets, have been losing a lot of money in many countries. But Uber was essentially an instance of decoupling in which the customer does not want to drive the car. He wants to go from point A to point B within a city without driving the car. Well, in some cases, you want to drive the car because you're going to a supermarket or you're going to go to many routes, right? And so many companies started saying, well, let's provide the car that you can just with an app, you can reserve a car, but you're not going to get a driver. You drive yourself. right? So in Boston, Zipcar was one of the first ones to do that. And in Europe, there's many companies that came about with this idea. Here's a car parked. You get a little card. You enter the car, you use it, and then you return it, right? So that's when you want to drive the car instead of be driven, which is the Uber model. But then, if you want to go from one city to another city, if I wanted to go from Boston to New York, it was very hard to get an Uber driver to take me. Or right now, I'm in San Diego to kind of San Francisco. Nobody's going to take me there, right? And so a startup out of France called BlaBlaCar decided to become the Uber for city to city. And it became very, very successful in India, where there's a lot of commute from different cities, and in Europe, where there was a lot of commute from shorter distance cities, right? So BlaBlaCar became kind of what the Uber is disrupting taxis. BlaBlaCar is disrupting the bus from city to city, and that allowed you to do that. So you can see that in principle, the sharing economy is I can use something without owning it. So I can use a car without owning the car. I can use luxury handbags or luxury dresses without owning it. I can use a house without owning it, and that became Airbnb and many other examples, right? So decoupling ownership from usage was the big power of the sharing economy. And within the ride sharing model, there's many different segments of that, including my own favorite that I use all the time now. A founder from Harvard Business School created Turo. And Turo is essentially, it's very analogous to Airbnb, in which if you get a car, you can rent a car for a few hours, for a few days, but you rent not a car owned by a company, but by your neighbor. So your neighbor puts a car online that they're not using it. You go and you get your neighbor's car and you pay them just like you would do Airbnb. So you see, there's a lot of segmentation in the sharing economy, Swami.
Yeah. So clearly, the way you break down the customer activity is very interesting, and you talk about the definition of a business model, right? So therefore, the business model, I think you've come up with a very interesting definition where you say model from the customer's point of view and not just about creating and capturing value. So can you walk us through how you define a business model and how is it different when you really capture it through this whole framework of customer value chain?
Sure. So first of all, the vast majority of people that I talk to, very smart people, either students, executives, entrepreneurs, they don't have a clear notion what a business model is. When you ask them, what is your business model? They generally describe what I call an operating model. The operating model is essentially, what are the activities that you're doing? What are the processes that you're doing, right? And so many don't have this clear understanding. The most basic and generalizable sense of explaining what a business model is how do you create value, and for whom do you create value, and then how do you capture some of this value that you created in the form of profits, and from whom do you capture this value, right? So in the case of Facebook, of social media, how does Facebook create value? Well, one of it is by creating content, peer-to-peer content, right? And how does it capture value? It captures value from advertisers. It doesn't capture value from the consumers. It captures value from advertisers, and it has a bidding mechanism to make sure it captures the most amount of value, right? So that's kind of the simplest way to explain Facebook's business model. Now, if you want to do firm-centric innovation, you take that approach and you innovate based on what your company wants to do, right? So I want to do this, I want to do that, I want to make more money here. You use the standard definition of a business model innovation, and a business model, and then you innovate on top of that. Now, consumers like you and me, we don't care about what businesses are doing. We care about what problems we need to solve. Right? And so I have a bunch of problems in my day-to-day life that I need to solve. And I don't care about the business model of the company. I couldn't care less. Well, we do, because we're interested in understanding how to build businesses, but my kids and my wife don't really care, right? And so what they care is they need to solve problems, or they need to acquire goods and services that they desire, and they're looking at what's the best option to do so. And in the process of looking, they're evaluating things from their point of view, not from the company's point of view. So they're looking at what creates more value for me. And so we don't in our house, we don't have cable television because we don't think that creates much value. Having 300 channels, and then you have to be ready at the time that they're going to show the show that you want, and you flip through the channels and you missed it and you forgot about it, and it's a nightmare. And then you have time, but you're not watching anything interesting, and you flip through and you take half an hour and you just give up, right? That doesn't create value for me. So when streaming came about, it created a huge amount of value for me because I could look at all the shows and then I say, well, now I have the time, I can watch what I want. And so that was an extremely value creating activity for me. And that's how I evaluated streaming, right? And then the capturing aspect, I said, well, I don't care about it. I care about charging. How do they charge me? Well, they charge me a subscription and I can cancel anytime. And I said, that's brilliant. Okay. So now in our household, we've been using Netflix for 10 years or more at least. And to me, Netflix provides so much more value than it charges me. So the difference between how much value it creates for me and it charges me is so big that if Netflix tomorrow said, we're going to double the price because my whole family uses it, I would say, of course, here's more money because it creates so much more value for me. And the cable companies create much less value for me and charge much more. So that's why I'm not a customer, right? So that's the difference, right? So what the big thing that I've learned by visiting all of these startups and advising startups and helping big companies create their own startups and, working with my students to create these startups is this. What I've come to realize is that customers disrupt markets. It's not the startup that is disrupting markets, and it's not the technology that is disrupting market. It's the customer who wants something different, changes their behavior, and because startups tend to operate, see it, and build a business model for that need faster. That's why startups are getting so much traction in many markets. But you need to have the customer changing their behavior. Right? So when you and I and Vignesh, when we arrive in a new city, in an airport, and instead of getting a taxi, we just call, Ola or Uber or Grab or, any other ride-sharing company. That little decision that we made, multiplied by the millions and millions and millions of occasions of all of these customers that decided that they don't want the taxi experience, that has disrupted these markets around the world. When we decide, instead of owning a second home for us to go for the weekend, just going online and renting somebody else's home, that big activity collectively has made huge disruption in the hospitality industry. So customers disrupt markets.
I think that is a super powerful idea because when we look at the way that the behemoths of the past really sort of died down once the age of the internet came in, I think one way that we can actually process it is through this idea of layering, and that is what I wanted to ask you about, which is the 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 IBMs of the world had a certain way of building products. They had a certain way of selling it to customers. They had a certain way of branding and marketing it and understanding whether it was succeeding or not. And whereas when you look at the Airbnbs of the world and the Netflixes of the world and the Warby Parkers of the world, one thing that really stood out to me is that these young firms understood at their very core the theory of jobs to be done. They understood what jobs that their customers wanted to do. They contrasted that with what the existing value chain was offering to customers, understood where there was delinks or poor linkages, and went and innovated in those spaces and actually gained market share by that. Is my analysis correct?
You're spot on with this. It's this idea that so first you need to work, or you have to help big companies to understand how they make their decisions. And by working with many big companies around the world, um, the analogy that I make is going to a casino. Big companies are like rich people going to a casino. If you observe a rich person entering a casino, they don't go to the slot machines. They don't go to the roulette. Why? Because in a roulette or a slot machine, you and I versus a multimillionaire, we have the same chances of winning. And rich people don't want that. They want better chance of winning. So they want to the games in which their money has a slight advantage. Poker. Poker, if you arrive with more money than others, you can bluff, you can kind of put more money, you can put it all in, you can frighten your opponents. So you have more resources, and big companies want to enter markets in which they have a quote unquote unfair advantage, right? And that happens. So if you see a bank wants to enter a market in which they have an unfair advantage. And what is their advantage? Banks have branches. So when they have, 1,000 branches, 2,000 branches, they are thinking, what new product can we come up with that we can sell across all of our branches? When a retailer, supermarket, they want to go into a market and they want to squeeze their suppliers because they're big and they want to get lower prices and they want to sell it in all of their stores. That is an unfair advantage versus a smaller supermarket or a one shop across the street. Telecom operators, their unfair advantage is all of their cell phone towers and all of the cables that they've invested to put in people's homes. So any new product in their mind is like, what can we do with our resources? That's what I call a resource-centric view. They focus on their resources and how do they take advantage, just like the rich person going into playing poker, right? And when you contrast that with startups don't have the resources. They don't have the thousands of stores or the tens of thousands of bank branches. The only thing that startups have is looking at like you say, a customer need that is a pain point, unfulfilled, a job that the customer needs to be done that big companies are not doing well. And so the startups have a focus on that activity and they don't have the resources. So they're trying to really improve the service for the customer, or the product for the customer. That's all they have. And so they focus on that versus the big companies are focusing on using their advantage to extract more value from customers. And that's where it goes down. A great story that I like to tell is in the United States, remember in the times of video rental services. So when Blockbuster was the biggest company, it had tens of thousands of stores. When Netflix came about with video by mail, Blockbuster started seeing people weren't going to the video store anymore, right? And so Blockbuster said, well, we need to make more money. And they decided to sell candy and ice cream in the stores to try to make money. Because then they had thousands of places to sell candy and ice cream. But they missed the point. People were not going to the store anymore. You can sell whatever you want at your store. It doesn't matter. And, instead of them realizing that kind of people wanted convenience, they don't want to go to the store. Going from your house to a store to rent out a movie is a value eroding activity in your customer value chain, right? Getting the DVD by mail, much more convenient, and then streaming, the ultimate convenience, that took down the hundreds of thousands of video rental companies all across the world.
And the other thing that I have also noticed is the amount of signal to noise ratio that big companies have versus small companies. Because when you are a small company, you actually have those true believers in your product who are actually using it and giving you constant feedback. You launch a product, you create a parallel Slack community or a Discord community, and your users are giving you feedback on an hourly basis, and you're getting real live feedback, all signals, right? Because the sample is so controlled, versus when you're having large companies trying to adopt the same frameworks that a startup does. Now, because IBM, let's say, has, for example, 1 million customers, how do they even distinguish what the signal and the noise are? How do they even know today who their core customers are, or what is the value that their customers are actually finding in the products and services that they're building? So, what is your take on this sort of dichotomy that you see between large and small companies in terms of how users give them the data that allows them to build the right products for them?
So the way big companies innovate is they have lots and lots of discussions, lots and lots of meetings, board meetings, discussion, until at one point in time, because you have so many people, you're never going to have consensus. It's impossible. The more people you have, the more different views you have, until somebody more powerful, generally, smacks the table and said, "This is what we're doing," and then they put all their resources in. So they go very slow until somebody decides, and you put all your resources in. When you put all your resources in, you're not trying to get signals from the market, whether they like it or not, whether you should invest more. Then it's about kind of, you're off to the races, and you're going to race as fast as you can. So many companies don't even do the process that you described of trying to understand whether you have product market fit, whether you should invest in this, whether you should pivot, move to another offering, change the offering, all of these things. You're getting data from the customers, but what big companies use from this data is much more validation and figuring out how to charge more money and from whom to charge more money. Instead of, do my customers really like and value my product, right? So this is where there's a big shift. Startups, their view is, we need to create a very high value creating product, something that customers love. Why? Because if we do that, one day we might extract a portion of this big value, we might extract a portion and capture some of this value for us. Big companies are always thinking about, how do we maximize the amount of value we extract from customers? And they're getting data to figure out who values our product more, because whoever values more, we're going to charge more. So it's a very, very different view, right? Big companies, if you ask them, they say, what's the most important, element of your business? They'll say some resource, like the number of stores we have, the number of branches, the number of cell phone towers that we have. That's the resource centric view. They think they build resources and make money out of these resources. The customer is just like way down there. It's like almost like a nuisance, a problem. There's a customer there. But we make money out of resources. Startups saying, we make money out of customers. Customers are our most valuable resource. And so that's when Netflix decided to move from sending DVDs by mail to streaming. It imploded its business. All the resources they had a bunch of DVDs, they have warehouses. They just threw that away to go from streaming, right? With Flipkart, when Flipkart decided to move from just a pure marketplace in which they didn't acquire the products to moving into kind of being a full service e-commerce shop, they realized they needed to educate the mom and pop shops to sell online. And until they educated that, which is the investment in their customers, they needed to buy these products and ship it to consumers, because consumers were having a very bad experience. They were getting delayed products, broken products, all of these things, and it was imploding Flipkart. So they needed to shift away and saying, who are our customers and how can we create value for them such that in the future we can capture value from them?
So Thales, just a final question in this thing. I genuinely, when you were talking about uh, Blockbuster, there's a question that I've not heard many people ask. So I'm going to go ahead and ask you. There's a lot of talk about product market fit, seeking product market fit, or what are some principles or some metrics that you have to sort of set to hit product market fit. It varies from industry to industry and service to service. But one question that I've not heard many people ask, and I want to ask you, is what is the opposite of product market fit? Right. So when you take a large company like a Blockbuster, which did have product market fit at one point, it lost that product market fit that it had. So, what might be certain changes in the value chain that happened that made Blockbuster lose its product market fit? And if you were a conscientious leader who was actually following the data trail, how would you sort of analyze that, hey, we are losing product market fit? How do we term this? How do we put a contingency in place? And how do we win back that loss, or that small territory that we lost to Netflix? How would you think about that? What is the opposite of product market fit?
Hmm. That's a great question. I've never heard somebody express the question like that. It's always about how do you get it? How do you get it? But your question is, how do you lose it, and what do you do to avoid losing it? I'll to really be good at it as an academic. I would need to think about it. I need to go back to the drawing board and think about it. Good. But for not having the time to do that, I'll give maybe a few pointers about that. So first, going back to that first principle that customers disrupt markets. They often disrupt markets because their needs change. And one dimension of changing needs that I've been observing working in a variety of industries, both for incumbent companies and startups across the world, in Brazil and India, Europe, Asia now, and US, is consumers have been on a secular trend of wanting more convenience in everything they do. A need for convenience has exploded in a way that in the past it wasn't as much. Right. So, in partially, Amazon in the U.S. was responsible for this. Amazon just gave a dramatic amount of convenience for people to buy online and receive their packages. And we as consumers, we don't have many brains for shopping for many different products. We have one brain. So the same way we make decisions about buying products online, we make decisions about buying education, or which podcast do we listen to, or where do we travel, or what car do we buy. We make the same decisions. And we consumers have started getting a taste for high convenience, like buying something online and receiving it 2 days later. And we're applying it to many different industries, which is actually needs that we have. So now I need to watch TV or watch movies. And to me, it's an inconvenience to go to a movie store to rent a movie. I want to press a button and watch a movie, right? So this need for convenience started rising in many industries, and many startups realized that and started delivering food, education, transportation, like Uber, healthcare. You can go online and talk to your doctor as opposed to wait for a month and go to their office, right? And this has been going across many industries. So it's like dominoes that fall, and the first one was Amazon, and all of the other ones. So this need for convenience was really responsible for the downfall of Blockbuster, because Blockbuster was not convenient. I had to go to the store, and then I had to go through all of these movies and spend half an hour to choose the movie I wanted. And then I hope that the movie's there and nobody rented the movie, and then I go back and I watch it later. Right? So when need for convenience started growing, Blockbuster executives should have realized, one, we are a very inconvenient business, because if we mapped out our customer value chain, there's a lot of value eroding activities that we're forcing our customers to do. And Netflix came in and eliminated, decoupled all those activities. And point number two, the need for variety, right? Netflix or online, you have, millions and millions of things to watch. Whereas in Blockbuster, you're limited by the volume of the store. And now we want a huge amount of variety for everything that is available to us. And that's the power of online businesses, that they don't have shelf space to worry about, so they can offer everything. So, I'd say that as we see these dimensions of consumers becoming more interested in certain criteria, like convenience, variety, and now more recently, we're seeing consumers wanting more health and wellness with COVID. Now they want health and wellness in everything that they do. This is another dimension that is probably going to create product market fit for some startups. And as you say, break the past product market fit for some other businesses, like banks. I don't want to go to a bank branch and deal with all of this, wait for people in a bank branch. I just don't want to deal with that, right? I want something online. And so I'd say probably focus on these core dimensions and make sure that as your customers change, you keep looking at particularly the value eroding activities that you're offering and figure out a way to eliminate those as the startups are doing.
So, Talis, I'm just going to zoom in into a linked question where if you really want to look at the decay of your product market fit, right? If I were to call it that way, right? Uh, you really are talking about something very interesting where you say that executives must actually possess the skill of wave spotting, right? So where if I'm working in a corporate, I tend to get comfortable with what happens every day. Okay. So therefore, you need to have a sense of wave spotting in your skill where you're actually looking at business and saying, you know what, looks like there is a wave that's happening and I need to get my company ready for it or my product or my service ready for it. So if I were to build that wave spotting skill, what are the kinds of skills that I need to develop in my arsenal to actually ensure that this decay of this product market fit probably, I'm able to reduce it in my company.
Mm-hmm. Well, I'd say that you have to start by kind of understanding customers. If you want to build customer-centric business model that provides real value for customers, or if you want to keep the value that you're offering to customers really high, you need to have customer-centric processes. Now, for big companies, that is extremely hard to do because companies are really incentivized, and executives and managers in companies are incentivized to kind of grow the company, make more money. So there's very few metrics of benefiting the customer, and this view that if you benefit your customers, you'll indirectly get a benefit yourself and retain some of that benefit in the form of profits. But it's mostly, most executives are really focused about growth, about profitability, about kind of increase the take rate that they get from all the products and services that they offer. So they're very firm centric. Every CEO that I meet, I asked if they're customer centric, and all of them, with one exception ever, told me, yes, we're very customer centric. Customers are most important for us and all of these things. But in the reality, you and I know when we shop for products and services, we're often badly treated by telecom operators, by banks, by airlines, often by hotels. We're not very well treated. We don't feel that they're focused on us. They're focused on, themselves, their processes. Only once the CEO of Siemens in Brazil told me, Professor Teixeira, I would like to say that we're very customer focused, but in reality, we're product focused. We're an engineering led company, and our engineers build the best products, and we think our products are the best in the world. And we try to push those products to our customers and educate them to why our products are best. And if they don't buy our products, we just say, you don't know what you're talking about. You don't understand. Like, you don't know how to judge quality. Right. So that was the only case that somebody was really honest to me saying we're not customer focused. And in reality, I think that's what most big companies are not. They don't prioritize this. They don't incentivize this. And so how do you transform this? It's a cultural transformation to really focus on customers. And part of my job is going to big companies and kind of setting up processes and helping change the culture to do more customer-centric innovation. And before the wave spotting, that is your question, you need to kind of like refocus on customers, right? And many companies are far removed from their consumers. And that's a big challenge. If you manufacture a product, so I advise auto companies. They don't know what the heck their customers want, their consumers, because auto companies sell products to dealers. And so every month, every week, they go to the dealers and they say, what do you want to buy? What is good? What do you need? How can we get you to buy more of our cars? And then the dealers focus on selling cars to us consumers. But the auto companies, the auto executives, they don't really have this close relationship with their consumers. So when consumers change, it takes a while for the auto dealers to realize it. And then it takes a long time for the auto manufacturers to understand it because they're not collecting the data for the consumers. And every now and then they do a little survey with consumers, but it takes them a long time to do it, 6 months to do it. And they don't pay too much attention to this. So the same thing with, many manufacturers of goods, that there is a distributor, there's a retailer, and then there's a consumer. They're far removed. So, Swami, to do this wave spotting, you need to be close to your consumer. There's no way out of it. You can't be on a phone line talking to somebody that's talking to somebody else that's talking to your end consumer. We play a game in Brazil of this phone line in which I say something, and at the end, the other kid would listen. I would say it only in the ears. The other kid would listen to something completely different from what I said. That's what happens in big companies. And so you need to get closer and closer to your end consumer as close as possible. And the closest way to do that, the best way, is to sell it directly to your consumer as a way to understand them. And when they change, you automatically see the signals, right? And so that's extremely important. I visited many tech companies, Google, I visited Airbnb, I've talked to many Uber executives, Netflix, as I said. And one thing that I've learned about big tech companies, there's two priorities that they always have, no matter what product or service they're launching. There are always two key priorities that they will never ever give up, no matter how much money they could make. The first one is they want the relationship with the end consumer. They will never be intermediated by another company. They'll sell directly to the end consumer. Number two, they collect data on the end consumer. They will always try to figure out how to collect data on the end consumer. How do they buy? How do they use the products? Because those two things, if you have the data on how consumers are using your products and you have the closest relationship possible, then the sky's the limit. Whenever your consumer has a new need, you can quickly see it. The signal is very, very strong and it's direct. And then you can be customer centric. And then these waves that you talk about will be very obvious to start to identify it. But if you're far removed, if you're not collecting data, transactional data and usage data on a day by day basis, you're just hinting at what consumers might be thinking of.
So one of the CEOs who I was talking to, he said, Swami, we spend a lot of money on patents. And therefore, for me, I'm in deep tech. I have a lot of patents, and therefore, I'm building competitive advantage for my company. Do you see a correlation between patents and revenue growth, and therefore, actually, earning market share? Do you see any correlation at all?
So, in my book, I did an analysis, maybe chapter one. And by the way, the name of the book is called Unlocking the Customer Value Chain. And I did some research to try to understand this idea, because, as you say, many companies have ideas, they create a patent, and they hope they'll secure what we call a moat, right? A defense around it, and be able to create products and sell them. And we worked with lots of startups to get the patents and then the increase in revenues. And suddenly what we realized by doing statistical analysis, rigorous statistical analysis, which it's my background in academic background, is that it's not that more patents generate more revenue. It's actually the opposite. More revenue generate more patents. So instead of the patent being the key element that makes your company grow, for the vast majority of companies, including big tech, it's only companies that grow start getting more patents. So patents are like the fountain water in your lobby of your big building. That fountain, if you go into a bank in New York City or in Mumbai or Delhi, and you enter and you see these beautiful fountains or a beautiful lobby, does that make the company richer? No, absolutely not. Nobody would say, well, this is making. Oh, so why do these big companies have it? Well, because they're big, so they make money and then they create their fountains instead of the other way around. So kind of patents in most cases, not all of them, but in most cases have shown to be a luxury, the result of success and growth versus the driver of that, right? Because the vast majority of these patents are worthless. Many of them, there's many workarounds. So the patents is one way to do something, but then other competitors can explore many other ways. Defending patents are extremely expensive. You end up enriching the lawyers above all, and you start focusing too much on trying to create paper-based innovation versus real customer-centric innovation. And that's what's more important. So patents are extremely valuable for a few select cases, but there's an industry of lawyers that have helped make patents such a big strategy, which ultimately in practice, it really is not what it seems to be.
So, Talis, I just want to go back uh, to this article that you had co-authored on Harvard Business Review Working Knowledge website, where you were talking about how Uber, Airbnb, and Etsy attracted their first 1,000 customers. Now, there is always a struggle in startups to acquire their first customers. Now, could you talk to us about the insights you uncovered when you looked at how these companies actually acquired their first 1,000 customers? And I have a follow up question to that. So, yeah.
Sure. So before that, every time I write an article, I write down what I think is the answer to the problem, right? And I talk to a lot of people, and they help me. What is the answer to the problem? So how does a tech startup acquire its first 1,000 customers? Well, before I went and visited and talked to these companies, my initial answer was, well, if you're a tech or digital startup, first you're going to acquire them online. Makes sense, right? You're an internet company. Why don't you use the internet to acquire? Why don't you use Google and Facebook and so on and so forth? And so I thought, that would be one way to acquire. The second idea was that, well, if you look at Uber and Airbnb and Flipkart and Etsy and Facebook, and they're just amazing products right from the start. They acquire customers because they were just amazing. They were great. They were so much better than the other ones. So I wrote these two things down. And in talking and seeing what these startups were doing in the early days, because there were a lot of articles about how they were doing now when they're already big, but I didn't see it. Like, I wanted to know the genesis when they were babies. How does the baby grow? How does the baby take their first steps? And in talking to them, first I realized that the vast majority of them did not use Facebook or Google to acquire customers. They tried, but it was too expensive, and it was like acquiring customer one by one. That wasn't going to make them grow fast. They couldn't take one step and another and another and another. They needed a few jumps. And they realized that the jumps that you get is by going offline, much more effective, and trying to convince people offline to use your product. And if you go one by one, it takes too long. So they would go offline to places where there are a lot of customers, right? So in the case of Uber, well, if you go to a street corner and try to get customers to use Uber for the first time, they're going to say, well, what? I'm not going to use this. Why would I? This is so risky. So they would need to go to places where there were more demand for taxis than there were actually taxis. So at the end of a concert or a sports event, there's tens of thousands of people coming out, and there's not tens of thousands of taxis. The first one gets the taxis, and then the other one have to wait or walk home or get a ride with a friend or something like that. And so they went there and they kind of said, you want to wait for the taxi? Yeah, but there's this new service, Uber. Download this app, try it out, and see if you like it. And they got a lot of customers, right? At the airport, they got a lot of customers because there was a line waiting for taxis. Airbnb, when there were certain big events or big conferences in the US, all the hotels were occupied. There was no place for people to stay. South by Southwest was a case. So they went there offline and started saying, hey, do you need a place to stay overnight? Try Airbnb. It's not great because we're just starting off, but hey, what are you going to do? Where are you going to sleep? And so they went and they, what I call number one, they acquire customers in bulk. They used other networks offline. They did it offline and they acquired customers in bulk and went in bulk and got many customers at a time, right? Not using my original thought, which is acquiring customers online one by one. The other point that they did is, this idea that the service, it leads to this. If you don't have any alternative, you'll take whatever you can get. So in the early days, when you look and when I teach the class of Harvard or at the University of California, I show the websites of these businesses. They were awful. They were god awful. You go and look Flipkart's original website, it was awful. Facebook was awful. The vast majority of these companies were so bad, yet they acquire customers, right? Why did they acquire customers? Because they had something that the others didn't, but they went where people were needing it. Again, Airbnb, there was no hotels available, so might as well try this thing out. And then people tried it, and then people started talking to each other about it. And so the word of mouth kicked in after a while, and it started growing the business. So when I teach my students, first, you don't need to build a brilliant new product, an amazing website. You just need to tap into a customer need that is being unmet. And try to do it when you find an instance in which the demand far outpaces the supply of it. The established companies get all of the customers, and there's still customers left, because then you're not fighting with an established company. Do it offline. You'll learn, to your point before, you'll learn about what customers want. You'll have a relationship. You understand how to pitch to them. You'll learn very quickly, and you acquire in bulk. I use the concept of other people's networks. Go tap into other people's networks. It could be a church, it could be a school, it could be the airport, it could be, the end of a big sports event or a concert. This is a network of people needing certain products or services, right? And then offer an experience that is good enough that will create the word of mouth cycle such that they'll tell their friends and friends of friends and so on and so forth. And that's how these companies acquire their first few thousand customers. And it's very different from what they do today. And that's very important. At every new stage of the startup, you need to change your customer acquisition strategies.
Uh, so one thing that you've written in this book, which caught my attention, Thales, is you said big companies have to do something called recoupling, right? And while you talk about decoupling, and we talked about how these large companies find it very hard to compete with these ones that decouple the market and decouple the customer needs and provide a kind of a service to these customers. Large companies, if they want to compete, have to recouple. Can you give me some example of recoupling? And I think that's a good way of actually saying, if I'm a large conglomerate or a large company, how do I recouple?
So, as you say, the big companies are being disrupted by decoupling because one or multiple startups are stealing activities from them. So, in one case, and I wrote a Harvard Business School case, was on Best Buy. Best Buy is a major electronics retailer in the United States, the biggest in the world, the biggest in the US. In India, you might have, what's the biggest electronics retailer in India?
You got Chroma, you got Reliance Retail. So
Yeah, okay,
those are the two
Reliance.
large
Reliance
ones.
Industries does everything in India, so you got Reliance as well. So, you know, these businesses, if you're a retailer of electronics, people need to see the product. They need to see the TV. They need to hear the sound of the sound system that you're buying, and then they purchase, right? So you need to go to the store, see it. If you like it, you buy it. Online, companies like Flipkart and Amazon and Walmart that are selling electronics online, well, how are you going to see or hear the sound? How are you going to test the computer? You can't. So what did these businesses do? What did Best Buy do? Or what did Amazon do when it started competing with Best Buy? It created an app that allowed you to go to a Best Buy store, check out what TVs were available, look at the screens, see which one you wanted to buy, and then you take a picture of the TV, scan the barcode, and then you see if Amazon is selling it online cheaper. And because Amazon doesn't have employees, salespeople, doesn't have stores, it could sell TVs cheaper than Best Buy. And so consumers started decoupling Best Buy. They would go to Best Buy, ask for salespeople's help. They looked at all of this, and then they would buy it on Amazon, what we call in the US showroom. You go to showroom, and then you buy it online. That was decoupling. So Best Buy said, well, how are we going to respond? First, it started saying, well, these people are coming in with cell phones and trying to see online. What if we buy signal jamming devices, put it in the store, just like the ones that people use in prison, to make sure that, like, when you try to use your cell phone, you can't. It's blocked, just like if you were in prison. Well, that's a crazy idea, right? Very non-customer centric, like attacking your own customers. I mean, bad customers, smack it in the head. Well, obviously they were more thoughtful about that, and they realized that if customers want to decouple, they want a showroom, we need to let them. We need to let our customers do what they want, what they value. And so they started creating TV commercials saying, come to our stores, come showroom, come check out the new things, if you buy it or not. But obviously, this broke the business model of Best Buy. How can it sell if people are buying lots of products online or Amazon or elsewhere? And so it needed to rethink its business model. But this attempt at recoupling, which is forcing people to do both things, forcing people, if you come to the store, you will have to buy our products, by trying to block Amazon, wasn't working. Other stores around the world have tried to recouple by charging customers. If they leave the store and they don't buy anything, they have to pay $5, something like that. There's examples of that in Australia. Very, very anti-customer centric, right? There is examples of stores that are trying to figure out, well, let's sell them coffee or other things in the store or charge for parking, and then we're trying to make some money. But ultimately, many of these attempts at recoupling failed. I don't have, in electronics retail, I don't have a success story to show of recoupling, but that's generally what the companies try to do. If you break something and steal something for them, they want to get it back and recouple it. So in the book, I explain how this often doesn't work because it is anti-customer. And so what Best Buy realized is they asked the question, well, if we disappeared tomorrow, all our stars disappeared, who would miss us? What value are we creating and for whom? Well, they knew that people that do showrooming would miss them, but also the manufacturers would miss them. So if you're Samsung, LG, Sony, Panasonic, or others, now people don't have a place to see the TVs and test them. Best Buy was one of the biggest. And so what Best Buy decided to do is they started charging these manufacturers for putting the products in the store, whether they sold it or not. And now Best Buy today makes a lot of money from manufacturers exposing their products to consumers. And so Best Buy became immune to Amazon, even became a partner of Amazon today because Best Buy makes some money from selling products, buying a product, putting a margin, selling more expensive, but makes another portion of the money from showcasing products to consumers, whether they buy on the store or online. And that in the book is what I call preemptively decoupling. You just separate your business. Now they have two businesses, one to make money out of manufacturers and one to make money out of retailing. And you rebalance the business model, which is you take the value capturing portion, which is only making money out of retailing, and move it to the showcasing products. So today, Best Buy works just like a media company. It brings customers in with great new products and discounts and all the new stuff, and it makes money from the manufacturers, just like a media company would do, just like a television station would do, attract attention and monetize that attention.
Fantastic, fantastic. So, Thales, for some closing questions that we have, for me, after listening to you, uh, I wanted to ask you, what are some of the books that have inspired you?
Mm-hmm. So I think that the first book I read was from my late colleague Clay Christensen, The Innovator's Dilemma. I think it's a phenomenal book. It shows how big companies die, essentially, how big companies fail to innovate. And it's a brilliant treatise on explaining the mechanics by which big companies die. And it's a very unique book, and it's extremely impacted my life. And I talked to Clay Christensen many times in the process of doing my own research until he died a few years ago. But he left a great legacy. Unfortunately, the book doesn't say how to avoid death. The book tells a lot about how big companies die, but it doesn't tell how to avoid the death. It's just a description of how big companies die. Another book, The Lean Startup by Eric Ries. I think that's a great book, and it talks about a lot about pivoting, experimentation, and getting signals from customers. So The Lean Startup I think it's a great book. Crossing the Chasm, that talks about kind of the early adopters, the late adopters, the laggards, by Roger Moore. I think it's a great book on understanding the difference between customers and their value for innovating. Because as a customer, if you're the early adopter, you're taking risks. And often companies or startups don't realize that. The first few customers to use Uber, essentially you are taking a huge risk. You're going into somebody's car, and this is not a company, and you hope they won't kill you. It's at night. I hope they're not going to kill me. I hope they're not going to just throw because I don't know. I've never heard of Uber. What? It's not a taxi. It's like a person's car. Who's this person? I don't know. Right? So there's risks to doing that. There's risk to renting a house on Airbnb because you arrive there and the house doesn't exist, or it's not their house. You paid somebody. So oftentimes innovators forget that consumers are taking risks for the first time. And you need to figure out how to get customers to trust and be willing to take the risk. And the reward has to be bigger, right? And so I think that's those are three books that I'd say.
So, Thales, thanks, Thales. So, my next question to you is, what does the word success mean to you?
What does the word success mean? I think success varies by each person. Each person has a measure of success. But I think success is basically, what do you want to achieve and how close are you to getting there, right? And so if you want to achieve building a big business, that's great. If you want to actually build a nonprofit and provide lots of values to many consumers and people around the world, that's great. That's kind of your objective. And so each one of us has to define kind of what they want to achieve. And success is how close are you getting to that? First, you need to know where you want to be, right? There's this nice saying that I love about Alice in Wonderland, the children's book. And Alice sees kind of one of the, this big rabbit in the woods. And Alice says, which path should I take? Because there's many paths. And basically the rabbit says, so where do you want to go? And she says, well, I don't know. And the rabbit says, well, then you can take any path. Any path will get you there. If you don't know where you're going, any path will take you there. So you need to know where you're going, because or else you can't make decisions on which path, which route to take, right? So I'd say that's, success is driving towards that end goal that you have in mind.
Great. Talis, my next question is, what's the one piece of great advice that you've ever received?
So you know, I was in I did college in Brazil, and then I wanted to get a job like everybody else, and the jobs weren't that good. When you come out of college, many of the jobs didn't seem like that wonderful to me. Wonderful businesses, but when you would ask them, "What am I supposed to do?" they would say a bunch of things that weren't that valuable. And then I had a professor who encouraged me to do a master's in statistics. He said, "Don't go get a job now. You're too young. Go do a master's in statistics and understand very deeply how to create knowledge from data. That will be extremely powerful for all of your career." And I said, "But I want to make money." And he said, "You're too young to make money. You're not going to make much money because you have very little differentiated skills versus other people that are coming out. You might think you're amazing, but you're actually not. And until you can prove that, you're just going to make just a little bit amount of money. And now is the time for you to develop yourself." And I think that was extremely valuable advice, right? So if you're coming out, like just learn as much as you can. And then later on in life, when you've learned so much, you can extract in the form of, getting a job and working or building a business, something like that. So early on, I'd say like the big advice was to learn as much as I could and leave the process of value capturing that we've been talking about for later on. Try to not want to capture a lot of value, when you're 20, 21, 22, because there's so much complexity in the world, so much that you need to invest time in kind of creating knowledge. And later on in life, you can kind of start extracting value. And for the most successful people in the world that I've talked to, the most success when measured by a certain amount of wealth, they keep telling me, "So Talis, like I'm 60 or I'm 70 or I'm 80 or I'm 55 or I'm 40, like 80 to 90% of my wealth I captured in the last 10 years of my life." So you can see that, like if you learn powerful ideas and concepts and theories and you learn about the world as much as possible, you learn that becomes fuel for you. And then later on in life, it's so much easier to monetize that than if you just try to make money and get the job that pays more early on in your career. And that's what I did.
So, Thales, my next question to you is, if you could invite four guests for a dream dinner, who would they be?
All right. So I've thought about this. It would not be Swami and Dinesh. I apologize, but if I only have four, if I have many, I can invite you guys. But if I only have four, it would probably not be neither of you, unfortunately. I think one I admire, the former U.S. President Barack Obama. I really admire him. I would have him at the table. I admire his thinking, his clear thinking. 8 years as president of the U.S., he would be extremely valuable to think about. One, I would invite, you didn't say if it was alive or dead, so I would definitely invite Steve Jobs to the dinner. I just understanding kind of how his mind works would be extremely fascinated. But there's only so much you can learn in a dinner. You need to have fun and you need to enjoy and have a few good laughs. So I would this also deceased. He was a kitchen chef, Anthony Bourdain. I really liked. He had these shows that would travel around the world and eat, and I thought he was such a fun guy, like such a cool guy. Right? This is like a cool, fun guy. I would love to have that, and then the last one would be definitely a comedian. It could be many of them, but I would just want to laugh, and there's many comedians out there. Stephen Colbert is a great comedian, and David Chappelle that I watched, very controversial, but somebody just to make me laugh during dinner. I think it would probably be something like those four.
That is a superb lineup. I'm probably gate crashing that dinner, so please forgive me.
Very cool.
Uh, uh, my next question, out of the last two questions, Thales, is what would be one piece of advice that you would give to an 18-year-old in an university or college today?
Innovate, innovate. No doubt about it. It's like I think part of the allure of your podcast, ContraMinds. ContraMinds is, I think, like, different from the standard, right? As I would understand it, like it's like, thinking differently, just like the Apple tagline, right? Think different, but like thinking differently, innovate. When I graduated from college, there was no the path to innovation wasn't available. You either were rich and you would take over the family business, or you would go get a job in a big company, IBM, Coca-Cola, Boeing, Microsoft, all these things, and rise up as an executive. And I'm talking about undergraduate in business education. But the startup path, mostly if you wanted to build a business, you would probably build like a restaurant or a hotel, something. It wasn't available now. And today I see the premium that markets and big companies are paying for innovation is sky high. You build something, the valuations are just dramatic. There's never that I can think of in the past, there's been such a premium to innovation as it is today. So I think as a young person coming out of college, you would be almost stupid to not want to try to come up with something innovative, an innovative product, innovative service, and an innovative business. Um, like innovation is at its highest price in the market today. So spending time with anything else to me is almost inconceivable, given the energy, the youth, the desire for disruption, and the market will pay for it if you come up with something. Either you IPO, investors are willing to bankroll it, big companies are willing to buy it at a premium, and so there's examples of small innovations that have gotten multi-billion-dollar valuations or cash outs. So I just say kind of, if you're not thinking, going out there, seeing customers that are unhappy and building something for them, I'd probably almost say you're wasting your time. You're wasting your 20s, so to speak.
So, Thales, my final question to you is, and before I ask, I want to thank you for sharing your valuable time with us. You spent close to an hour and a half, 90 minutes with us, and I hope you had a great time. And just as an extension of that, now that you've been a part of the conversation, you had a chance to experience what it's like. My final question to you is this: who is someone you would like to see as a guest on ContraMinds?
Well, I think I'd like to see a somebody who's really thinking something very differently, who's saying something very differently from the others. I like to think to see somebody who is talking about, innovation and entrepreneurship in a very different way. There's a few people that I've read certain articles. Steve Blank is one that would come to my mind. Eric Ries would also come to my mind as a potential guest that I would love to hear him speak. But entrepreneurs, Sarah Blakely has been remarkably successful. I would like to hear her. I think also female entrepreneurs, that they're taking a very different approach to entrepreneurship. They see things different from what men and young men entrepreneurs, male entrepreneurs do. And I think there's a lot to be said about the female founder voice that I would like to learn more. And there's many examples of those.
Thanks, Talis. We absolutely enjoyed this conversation. It was completely, I would say, authentic, things that came from your heart. And the way you spoke, we really thought we learned a lot of things. And personally, I learned a lot of things out of the many concepts that you have left behind. And I'm going to reflect on them, see if I can put them to practice. And I'm sure our audience, they're going to really enjoy the depth of what you said and the way things need to be done to disrupt markets, because customers disrupt businesses, and therefore it's important that we disrupt ourselves to ensure that we remain relevant in today's world. Thank you very much, and it was an absolutely invigorating conversation with you.
I'm so glad to hear that, Swami and Vinesh. Thank you so much for the invitation. This was a true joy and pleasure to talk to you. Obviously, I'm very excited about these ideas and any new idea that comes out in the space. There's huge opportunities. And thank you so much for putting together this and other sessions of the ContraMinds podcast. You're doing something extremely important, which is disseminating knowledge. And I really tip my hat to both of you for doing so.
Thank you so much, Talis. It is an absolute privilege.